is the Bank of Japan going to ruin the stocks rally for everybody? And are they really prepared for a sea change after decades on decades on decades of ultra dovish monetary policy? Welcome to Macro Money. This is Ilya Spivak, head of Global Macro here at tastylive. And we were going to talk about the Bank of Japan anyway today. They do have a monetary policy announcement coming up, but boy, did they make it interesting in the final hours of the U.S. trading session. This is going to be a volatile outcome, seemingly, no matter what they do and no matter how this goes, as we get the markets really very reactive to what is maybe setting up to be one of the more eventful monetary policy announcements on a week when we've already had the Fed and the ECB. And by the way, so far, it's the ECB leading for market impact. Let's see if the Bank of Japan can alter that calculus. We're going to be looking at here first how the rumor mill has moved the yen and broader markets. We're going to look at what is the reason why markets are speculating that there may be a change and whether that change actually makes sense from a BOJ perspective. And so what is the implication for markets if they do or do not actually choose to jump? So let's first take a look at the price action itself. This is a chart of Japanese yen futures here. And what we see last week, that big red candle that you see there, that's a report from Bloomberg News, no sources cited, of course. People familiar with the matter, quote unquote, apparently told Bloomberg News that there's no urgency to adjust policy at the Bank of Japan. They don't really need to do much of anything. Now, the reason that that's at all reactive for markets, considering that the Bank of Japan hasn't really done much of anything in decades, is there's been a more general sort of sense that maybe a change could be afoot. Part of that is inflation. Another part is the leadership at the Bank of Japan. Before we get into those nuances, consider what happens today when we get a counter report. This one from Nikkei News saying the BOJ might make some tweaks to its yield curve control policy. That's the policy of keeping the 10-year government bond yield pinned at 0% on global markets. The Bank of Japan has created a bit of volatility around this already. Earlier in the year, there was an allowance to let that yield go up and down by up to 0.25% around zero without intervention. In the beginning of the year, they winded out to 50. We'll talk about why in just a moment. That created a massive move higher in the yen until, of course, that move unraveled. We are getting some rumors here, and the yen is clearly reactive to those, that they may tweak this again. Why is the market suddenly so reactive to changes or even the hint of changes at the Bank of Japan? Well, let's consider. So the Bank of Japan has been trying to get to a 2% inflation target that is sustainable and holding for the better part of 30, 40 years. It took them some time to assert it as 2% formally over that period. Before, it was just getting inflation higher. But what we see now is that for almost a year now, inflation has been holding above that target. We also see that after peaking north of 4% in December, we seem to have now been holding above 3% and worryingly idling there, not falling. And so, not surprisingly, there's been some conversation that's started to spread around markets about, well, We're kind of holding above target here for a while, and we're holding at relatively elevated levels for a while, and we've stopped falling for a few months. Maybe inflation is actually getting entrenched. Maybe it's going to stay up here long enough that this is going to impact consumer behavior. That what we are going to start to see is businesses assume that costs are going to be higher, consumers assume that costs are going to be higher, and behave accordingly. If you think inflation is going to be higher and you think the price of something tomorrow might be higher than today, well, if you have the ability, maybe you'll buy it today. That starts to be the kind of virtuous cycle that the Bank of Japan has been trying to engineer by trying to get inflation off the mat to begin with. But if inflation is too high and if it gets there for too long, then maybe people actually defer consumption. Maybe businesses are faced with employees that demand higher wages, given the higher cost of living, and given that that higher cost of living seems to be getting stuck. And maybe what that does is increase the cost of producing anything or doing anything at all, because higher wages means higher labor costs for whatever business. And maybe that means that those businesses need to adjust accordingly for a higher labor spend, and that impacts their capacity to grow. So this could have significant implications if it were in fact sticky. So people are starting to think, well, it certainly feels sticky, looks sticky. Maybe the Bank of Japan needs to back away from some of this expansive stimulus that they've been attempting to largely unsuccessfully do for the past few decades to get this inflation higher. If we look at the breakdown here, we can see what inflation is made up of. And by the way, we should mention that one of the added caveats here in fueling the market's thinking, besides the fact that the BOJ opted to tweak yield curve control, as we just said earlier in the year, besides the fact that inflation seems to be getting stuck above target for almost a year now, the Bank of Japan, as of April, has a new governor. This is a governor that doesn't come with the usual pedigree for a Bank of Japan chief. Typically, Bank of Japan governors have come from the halls of government, people with long careers at the Ministry of Finance, at the Bank of Japan, elsewhere in the economic policy apparatus in Japan. The current governor, Kazuo Ueda, comes from academia. Not only that, he comes from a stable of economists mentored and coming up under the great visionary Stanley Fischer. Most recently, he was the vice chair of the Fed as far as formal positions. He's been at academic institutions. He's been at the IMF and World Bank. But this is the sort of ringmaster of a group of economists and was the thesis advisor for a group of economists who, in their leadership positions at global central banks, have been some of the most influential monetary policy makers of the modern financial era. And of course, I'm talking about Ben Bernanke, the chair of the Fed during the global financial crisis, and Mario Draghi, who was there during some of the financial crisis, and of course, who steered the Eurozone through the Euro debt crisis that followed. Both of them with a penchant for, let's say, not orthodox monetary policy, but quite a bit of creativity. And that creativity instrumental in both of them having been successful. Bernanke in containing what could have been another Great Depression easily, and the Mario Draghi example being so clever and so good in his tenure that he effectively prevented the collapse of the euro. So Kazuo Ueda comes from this group of folks. And there has been some speculation that not only does the BOJ now have the economic backing to do something different with this inflation sticky, it also has bold new leadership, not afraid of breaking with orthodoxy, and perhaps open to something of a sea change. So that's where speculation comes from. This is why markets are so reactive. Now, let's take a look at where we are on the makeup of this inflation that ostensibly is sticky, and some of this argument, frankly, starts to come undone. Notice here that the biggest contributor to inflation seems to be food. Now, Japan is an island. It imports tons of everything it uses. So not surprising that as we have a global upswell in inflation, it would import a lot of that. If prices on goods outside of Japan are rising and Japan imports lots of things from outside Japan, be they frankly goods or services, that's going to be inflationary. You can see here that energy was, of course, a major contributor last year, but since then, energy prices have fallen, and now inflation is actually being pulled lower than it might otherwise be by the cost of energy. Small contributions from housing, bit of a contribution from goods, bit of a contribution from services, but nothing runaway there. The really big wedge here is food. Let's consider that as we look at where things are trending. So if we consider here the mix between what inflation is doing, that's the yellow bars there, and what the market thinks it's doing, where the market thinks it's going, that's the 5-year break-even rate, we can see that inflation stopped falling just as inflation expectations idled. And now, after a bit of a outsized pop, appear to have reversed sharply lower. Now, the 5-year break-even here is, as ever, the difference between nominal and real bond yields, in this case at the 5-year tenor, that's the liquid one in Japan for inflation-adjusted bonds, so that you can take that difference. And when you do, the residual you're left with is the inflation expectation baked into bond markets that gets you from nominal to real yield. So you can get a sense of what the actual bond market is anticipating for inflation. Not somebody's forecast, not somebody's guess, actual bond market price action. Which, of course, is interesting. Now, it leads CPI by about 8 months here. You can see once you lag CPI 8 months to expectations, you can see the tops and bottoms broadly line up. You get the sense that then if there's been a pop and then a reversal lower, that CPI might then follow. And so although there might have been a concern that maybe inflation expectations are going the wrong way as recently as a month or two ago, now it seems like they've turned back around. That lag, of course, because markets are forward-looking and because it takes time to actually collate inflation data, release it, and so forth. So not surprising that when you look at something like a 5-year bond rate, you get a fairly significant lag. So what is this all about? Well, consider that 5-year break-even has largely moved with global soft commodity prices. This is things like coffee and things like cotton and things like sugar. Now, interestingly, soft commodities have actually been up even in an environment where broader commodities have been down recently. But there seems to be a clear sort of knock-on here. or at least a close parallel relationship between what soft commodities are doing. Remember, the biggest contributor to inflation is food, and what this 5-year break even is doing. And in particular, it seems like soft commodities are being driven higher by the price of sugar. There was a serious concern, and in fact, other soft commodities are actually quite a bit lower, that there was a serious concern that there might be a deficit in the sugar market because India, the world's 5th largest exporter, instituted export caps. They did so because they felt like their domestic harvest was not what they wanted it to be and that they might have domestic shortages, so they didn't want to export some of their supply. And so we've seen from about the back half of last year and into the first half of this year, a meaningful pop in sugar prices. That seems to have given a lift to soft commodities. But of course, now that move has started to turn back around. And that's because there's been a bumper crop in Brazil, the biggest sugar exporter. And so maybe that shortage concern is out the window. Now, this probably takes time to work through in markets. Sugar is not the world's most liquid thing ever. It's certainly not the S&P 500 or the euro. And so it can take these markets some time to kind of fully get on board with macro dynamics. But what we're looking at here seems to be already a topping in sugar because perhaps these supply constraints are ebbing. That, of course, might explain how Japanese inflation is primarily driven by food and how the break-even is tracking soft commodities. Sugar, of course, a critical input into food. And so that would start to make sense when you start to line it all up together. Now, if we look at CPI in Japan as relative to overall commodity prices, we can see, again, about an 8-month lag. And so what we see could be something that is a bit stickier, considering commodities have been up now for going on a second month if July closes as it's looking now. But as we see, the trend has been that as commodities bottom, inflation in Japan bottoms. As commodities top, inflation in Japan tops. And if there is indeed an 8-month lead here, well, then inflation in Japan has quite a bit more room to go down. And if, in fact, those commodity prices do launch a more lasting recovery, that might well eat into any disinflation, but it certainly doesn't suggest that we're going to be immobile here and now above 3%. And so we'll see if they do, we'll see if they don't continue going higher, but a sense of urgency for the Bank of Japan to change policy right now, given the train from commodity influence 8 months forward to CPI still points much more broadly toward disinflation, if maybe more modest disinflation after the past month and a half of commodity price moves than before them. Well, that sense of urgency doesn't seem to really be there to jump out the window and wildly alter monetary policy after decades of leading it in a direction. We should also point out that in order for commodities to provide imported inflation, even if they do go up, supply and demand will have to play a role. It's not inflationary to buy expensive things or rather, it's not inflationary that things become expensive if you don't then go buy them, because these are imported things. So if you don't have a move on the demand side, then the influence of a price rise on the underlying commodity might well be diluted somewhat. And if we look at the latest set of PMI numbers, we are now for 2 months looking at a Japanese economy that's broadly slowing. Manufacturing is under 50 on the index there. That means it is contracting. In the logic of PMIs, 50 is the center line, under 50 is contraction, above 50 is expansion. And the further you go in each direction, the faster that thing is. So the higher you go, the faster the expansion. The lower you go, the faster the contraction. You can see for the past 2 months, Japanese manufacturing is back into contraction territory. That's, of course, very bad news for an economy that's an island, export-oriented sort of an economy. At the same time, you see services weakening. So it seems like consumer demand is getting a bit soggier, and the overall economy has slowed now for 3 months in a row. And so what we're looking at here is weakness on the demand side that might dilute any influence from a global commodities influence, even if that influence sustains, which, again, there's an 8-month lag here. So does the Bank of Japan feel a sense of urgency to act? Maybe not. We get a similar story from overall flow of economic data. We can see this is a Citigroup index of how Japanese economic data is performing relative to forecasts. And it's been deteriorating all year, and now is actually sub the zero line, which means Japanese economic data is tending to underperform rather than outperform relative to baseline forecasts. So that speaks to an economy narrowly weaker than analysts' models are anticipating. And of course, those analysts' models are what drive market expectations and market responses. When outcomes veer from those baselines, that's what drives volatility. This does not speak to an economy bursting with demand just at a time when the price structure on commodities some months forward in CPI terms might start to look more inflationary externally. On the contrary, this seems still very much to be a story about food being the major contributor, sugar being the reason for that, those forces seemingly weakening, other commodities may be giving us a further boost later down the road, but if demand doesn't hold up, then maybe not very much of one. Then there is this yield curve control thing, the cap on yields. Consider why that cap was moved in the first place at the beginning of the year. The red line there is Japan's 10-year government bond yield. The blue is the 10-year overnight index swap. So think of the red one as this is the thing the BOJ is fighting to keep at zero. And the blue one is where the market thinks 10-year borrowing costs in Japan should actually be. So that's the no meddling by central bank version of 10-year borrowing costs, indicative. And so as we look at that, we see that the two move in lockstep until the beginning of last year, when, shock of shocks, the Fed begins its rate hike cycle. Now, when the Fed raises rates, it raises the cost of borrowing dollars, and the dollar is the quintessential commercial unit of exchange globally by a long mile. All of this dollarization talk sounds like utter nonsense, frankly. because 80+% of global monetary transactions, according to the Bank of International Settlements, are settled in USD, and nothing comes even remotely close to competing. So when you raise the cost of borrowing dollars, as the Fed did with gusto last year, starting right around the time that these lines begin to diverge, you get an increase in borrowing costs everywhere, not just the US, because what you're doing is increasing the cost of financing global economic activity in general, because that economic activity primarily runs on dollars. And so what you end up with then is the indicative rate for where Japanese borrowing costs should be, the OIS rate, that goes up. Meanwhile, the Bank of Japan is fighting to keep the 10-year JGB contained. And so you see it bumping and bumping and bumping against this 25 basis point ceiling that they were holding. And you see the spread, these gray bars, between where the market thinks it should be and where the BOJ says it is, widening. Now, the problems, of course, occur when this spread gets north of the 25 basis point allowance. That starts to tell you that, essentially, the Bank of Japan is running the risk of breaking the bond market. That essentially they are fighting something that the market says is incorrect. Well, then the Bank of Japan says, begrudgingly, all right, fine, we can't fight the markets forever. Nobody has bottomless liquidity to fight the entire market. We're going to allow for this to be a threshold of 50 basis points rather than 75. You can see that immediately the 10-year JGB yield moves higher to fill that gap. And of course, the yen surges as soon as that happens, because then the yield available on yen denominated assets is a little bit better than it was. But look at what's happened since then. These lines are reconverging. They're reconverging because, of course, the Fed is out of the very activist part of its rate hike cycle, where it's going at 75 basis points at a clip, meeting after meeting. They paused last month, and just earlier this week gave us a kind of non-committal, we're data dependent, we're in fine-tuning mode, maybe we'll get another hike this year, we'll see when it's time to cut. Markets think it's next year, but we're not committing, but also not saying no. The really aggressive part of U.S. yields being driven by the Fed and having that be a knock-on effect elsewhere seems spent. And so the spread here has narrowed to just 17 basis points. And that is not the kind of environment where the Bank of Japan feels the heat to do anything more on this, especially when the arrival of the new governor marked the beginning of a longer-term policy review, which they said is going to take a year and a half. That policy review is very much ongoing. The urgency, again, as with inflation, the urgency to act doesn't appear here, at least for now. Not only are we not near 50 basis points to challenge that cap, we're not even at the 25 basis points that was the earlier cap. Now, for context, has anything changed domestically in the big picture structure of why the Bank of Japan is even doing any of this massive stimulus? Well, consider what's going on. Japanese interest rates, along with inflation, have been in long-term decline since the early 1970s. They've attempted to do an absolutely eye-watering amount of QE to try to get that off the mat, because as we noted earlier, you need a bit of pricing power to goad consumers into buying things. And it hasn't worked. At this point, the Bank of Japan balance sheet is close to 130% of GDP. It's bigger than the economy itself, and by a good amount, by about a third, because they're trying to buy these assets to inject more and more liquidity to try to get inflation to go up. and it hasn't worked. And the reason it hasn't worked is because more money isn't necessarily going to get people to spend, because the actual demographic makeup of the population is increasingly adverse to that kind of a thing. Notice that the average working age population in Japan has been growing at an increasingly slowing rate and is at this point actually negative. It's shrinking. Now, when people are of working age, they're relatively younger. This is where they establish households, they buy homes and cars and put kids through school and buy those kids diapers and onesies and sneakers and whatever else there is. Increasingly, the makeup of the population in Japan is past the prime spending years as it ages. And so you could introduce all kinds of money into this equation. You're just not going to build the kind of propensity to consume that perhaps you're aiming for. None of which has changed because of a pop in sugar, none of which has changed because of the ebb and flow of global commodities, none of which is made any different by a spread between the yield curve cap and the 10-year equivalent that's not challenging the bounds of the policy. And so the question then becomes, why would the Bank of Japan do something incredibly destabilizing and aggressive right now? Well, perhaps they won't. And perhaps what they're trying to do with these rumors, as friend of the show, Chris Vecchio, head of futures and forex here at tastylive, has surmised, might just be to discourage speculators, to create volatility, make things feel uncertain, and dissuade people from betting too hard one way or another. If that means that the Bank of Japan does nothing when it comes out later today, we probably get a weaker yen. And given how much of an influence that's had on yields and on stocks in U.S. hours today, we might get slightly stronger stocks. We might get somewhat higher yields as well. Hopefully that wasn't too much information for you, but if it was, do go to the news and insights section of tastylive.com, where I've written all of this up in summary form. You can have that as a primer to go with what we've discussed here today. Thank you very much for listening. I am off next week. Macro Money will have video on demand content for you. Do come and check that out. I'm back the week after that. I probably won't be able to resist opining on Twitter at Ilya Spivak, so keep an eye on that if you like. That is Macro Money for this week. And we'll be back with fresh content the week after next, and choice replay next week. Thank you very much, everybody. Take care.